You can only suppress or manipulate a market over an extended period of time by pushing it in the direction that it is going. You put all of this together, there will be a moment when the world realizes that the sophisticated money has already positioned themselves in gold and silver by using the suppression of the Western paper exchanges to run cover for their acquisition. And once they've hoodwinked all the sophisticated so-called smart managed money traders into going short, they'll go long and stand for delivery. And I would argue we're getting very, very close to that. A backdrop like you see here, where 200 million ounces more than there are bars available to be delivered, although that will greatly pare down as we get close to the end of September, either by rolling those contracts over to December, cash settling, or some will settle for delivery. But typically we see that right towards the end of the contract, it all evens out. One of these days it won't. And when you're playing a game of that kind of excess rehypothecation, it's a dangerous one to play. For the first time in quite some time, the commercial banks are net long in silver on the commodity exchange. This is a very big deal. We've seen in the last several years 4 instances where the commercial banks went net long in silver, and it was followed by a massive run up in the price of silver. When the commercial banks go net long, that means the managed money is net short. And that is a very bullish formation, whereby the most sophisticated traders, Goldman, Citi, JP, they have hoodwinked the managed money into going short. They have been able to cover. The commercials have their old short positions and now positioned to see a major uptick in the price of silver. And I would argue gold too. While they're still a little bit short in gold, they sold off a bunch of their gold short positions, so they're much less short in gold right now. And I would say that as we head into the fall, the dynamics are such that I would expect a much larger rise in the price of silver and gold than people are expecting. Gold and silver are 2 of the only assets that carry no counterparty risk. So yes, I mean, I think that that is a place to go. And I want to make something clear. You know, when I answer things about gold and silver, look, for some reason, a lot of people think, not your listeners, but there are people out there that think, you know, good intentions, honesty, and you know, just doing the right thing has to be mutually exclusive from capitalism, from building a business. I will tell you, I try to be objective, and I don't see any other place I'd put my money besides gold or silver or short-term treasuries directly through the U.S. government. And I say short-term, 6 months or less, because you know, you don't want to be in a situation like the banks are, where rates spike and you have to come up with money and you have to sell your bonds at a massive loss, where if you're 6 months or less, you know, you don't have such a duration to worry about. So yeah, I would put my money in 6 months or less directly to the Treasury, treasurydirect.gov, or gold and silver. To me, those are the only places right now that I would feel safe. When you go through a period of suppressed interest rates and easy money, the distortions it creates in asset values creates a problem. The systemic nature of the banking problems and all of the money that's being pulled out, putting more and more strain, raising rates even higher, you're going to see some bank failures. And then when you do, I believe that they will be bailed in, not bailed out. I mean, that's the law. What you are seeing is a situation where, you know, the Fed's got interest rates at 5%. The banks are paying 1/10 that amount, and they're systemic. And as you see depositors pull their money out in search of yield at 5%, whether they're going directly to the big commercial banks, which you can do money markets, which are invested in the reverse repo market at roughly 5%, or you go directly to the Treasury at 5%. What is happening is that these regional banks, by which hold 70% of all the small business loans and leases and commercial real estate loans and leases, and all these loans and leases are due to reset over the next 15 months, about $1.5 trillion worth. These banks have very small reserves in terms of amount of reserves versus the amount of money that was deposited. And a lot of that money, the majority of it, went into treasuries yielding 1.5–2%, or mortgage-backed securities yielding 3–3.5% over the last several years. Well, in both cases, those assets are halved or more. If they don't have enough deposits on hand, and all of these people are pulling money out because the banks can only pay a tiny bit of return and have all of this risk tied up with it, and yet the Treasury will pay you 5.5% on a 6-month note, a Treasury bill. As all of these people pull their money out in search of yield, the banks have to sell their long duration unrealized losses that these long duration treasuries have, because they haven't sold them, in order to pay for the deposits being withdrawn, and then they become realized losses. And that's how Silicon Valley Bank went bust in 36 hours. But the reason it's a self-fulfilling prophecy is that as the banks sell these assets, in essence, as they sell them, the price of the asset goes down, and the interest rate on all of those older bonds go up. And so what you are witnessing is the fact that all of the banks, as they sell them, it erodes further the value of all the treasuries and mortgage-backed securities held by these banks, and it gets worse and worse and worse. This is something that is accelerating, that I think there's really no end in sight. And as rates keep rising, you're going to see more and more people pull out of these banks in search of yield. And it's illuminating to see that you're seeing even more money in terms of dollar value leave the commercial banks, because these are really big money, sophisticated investors who say, I don't believe Janet when she says that they're too big to fail. Let's go directly to the Treasury, buy short-term treasuries, and get all of the bank risk off the table. And that's happening. So between the regional and the commercial banks, we're seeing a mass exodus in search of yield out of the banks, and that's putting huge strain on the banks. If the U.S. government fails, we got big problems, and the banks are going to fail too at that point. So I like them, and that's where all the money is going. That's why you see Warren Buffett with $147 billion in short-term treasuries, 6 months or less, highly liquid, paying a rate of return. Why would you put your money in the stock market hoping to make more than 6% and have all that risk when you can go directly to a treasury? And that is what is really hurting the markets. It's hurting the banks, and it's just a self-fulfilling prophecy, which I believe you will ultimately see rates go higher, put more strain on the banks, put more strain on the markets, put more strain on real estate. The projections are that within just a few years, just paying the interest on the debt plus Social Security and Medicare would exceed all federal tax revenue. And this is becoming something that I think the rest of the world is noticing.